Hi and welcome to my channel. Datadog just did something that doesn't happen very often. It beat revenue estimates, beat earnings estimates, and raised its full-year guidance, and the stock still dropped nearly 19% in a single day. At first glance, that makes no sense. A beat and raise quarter is usually a green day, not a red one. But there was one detail buried in the report that changed everything. The company's largest customer, an AI-native business, pulled back its usage. That single account is now the center of the entire story. So today we're going to walk through exactly what happened, why the market reacted the way it did, and whether this is a Datadog-specific issue or an early warning sign for AI infrastructure spending more broadly. Before we get into the numbers, let's quickly ground ourselves in what Datadog actually does, in case you're not familiar. It's a cloud observability platform, basically a set of tools companies use to monitor their own technology. Application performance, infrastructure health, security, all in one place. If something breaks inside a company's tech stack, Datadog is often the tool that flags it first. It's been named a leader in the Gartner Magic Quadrant for observability for 6 straight years, and it counts roughly 4,720 customers who spend over $100,000 a year with them. This isn't a speculative story or an unproven business. It's a well-established company with real, recurring enterprise revenue. Now let's look at what was actually reported. Revenue came in at $1.12 billion, up 36% year-over-year and up 11% from the prior quarter, and that beat the high end of the company's own guidance range. Adjusted earnings per share landed at 65 cents, ahead of the 58 cents analysts were expecting. Free cash flow was $279 million, a healthy 25% margin. On every traditional metric you'd look at, this was a clean, strong quarter. This is where many investors get confused, because if you just read the headline numbers without digging further, you'd assume the stock had a great day. It didn't. Let's look at what actually happened next. On top of the beat, Datadog also raised its full-year guidance. The new revenue range sits at $4.45 to $4.47 billion, about $140 million higher than what they projected back in May, roughly a 3% bump. Adjusted earnings guidance moved up too, about 5% at the midpoint. Now here's the thing. Raising guidance is almost always read as a bullish signal. It tells investors that management sees enough strength ahead to commit to a higher number publicly. So between the beat and the raise, this really did look like a straightforward good news quarter on the surface. But there's an important trade-off buried in that same guidance, and that's exactly where the story turns. Here's the part that actually moved the stock. Buried inside that guidance was a Q3 revenue outlook of $1.135 to $1.145 billion, which works out to about 28 to 29% year-over-year growth. Compare that to the 36% growth they just posted in Q2, and you can see the problem. That's a real, visible deceleration, and markets tend to punish the direction of a trend more than they reward the absolute size of a number. A company growing 28% is still growing quickly by almost any standard. But investors weren't asking, is this fast growth? They were asking, is this slowing down, and why? So what's actually driving that slowdown? Datadog disclosed that its single largest customer, an AI-native company, reduced its usage of the platform. And here's the detail that makes this even more interesting. That same customer had just signed a 9-figure contract renewal. So the relationship didn't end. The contract stayed in place. But the day-to-day consumption from that one account dropped, and that was enough to visibly bend Datadog's growth curve. When one customer is large enough to move an entire company's guidance, that tells you something about concentration risk, and it's worth sitting with that for a second. To be fair to the company, management didn't try to hide this or downplay it. CEO Olivier Pomel described the usage reduction as something that was deliberately built into, or de-risked, within, the guidance they just gave. In plain terms, they saw this coming internally and already adjusted their numbers to reflect it before the market ever heard about it. That's actually a reasonably responsible way to handle a known headwind, but knowing about a problem in advance and having the market accept it calmly are two very different things, and this is where many investors get confused between well-managed risk and no risk at all. Now here's where things get interesting, because the headline story isn't the whole story. Outside of that one account, Datadog said its non-AI customer growth actually accelerated into the high 20% range. Its AI-native customer base as a whole grew past 750 accounts, and 31 of those customers now spend over $1 million a year with the company. So this wasn't a case of AI customers broadly pulling back, it looks much more like one large account behaving unusually. That distinction matters a lot for how you interpret this sell-off. Let's look at a few more numbers that tell us how healthy the underlying business really is. 58% of customers now use 4 or more Datadog products, up from 52% a year ago. 13% use 10 or more products, up from just 7%. And enterprise new logo bookings more than doubled year over year. What does this tell you? Existing customers are buying deeper into the platform over time, not pulling back. That kind of expansion is usually a sign of a sticky, well-entrenched product, the opposite of what you'd expect if the core business were actually deteriorating. Let's look at what happened to the chart itself, because the technicals here are notable. The stock had actually hit a record closing high just days before this report. After the drop, the Relative Strength Index, RSI, fell to around 24, which is firmly in oversold territory. Traders are watching $225 as the key support level. A reclaim above $241 would be the first real signal that buyers are stepping back in. Now, I want to be careful here. Oversold doesn't mean must bounce. A stock can stay oversold for a while if the underlying concerns are still fresh in investors' minds. So what does this mean for you as an investor? At first glance, this looks like a company-specific hiccup, one big customer, one unusual quarter. But zoom out for a second. AI-native companies are becoming some of the largest, fastest-growing customers across the entire software industry. If one of them can single-handedly bend a company's growth guidance, what happens if more of them start optimizing their spending the same way? This is where I think the real debate lies, not is Datadog broken, but is this the first visible crack in how AI companies spend on infrastructure tools? Now, to Datadog's credit, they aren't sitting still on this. They've been rolling out AI-specific products, AI Guard, Bits Code, Bits Chat, Bits Agent Builder, tools specifically built to monitor AI agents, AI security, and AI-driven workflows. The strategy here is pretty clear. Instead of just being a bystander to the AI boom, they're trying to make themselves essential to how companies monitor their AI systems, not just their traditional cloud infrastructure. Whether that succeeds is still an open question, but it's a reasonable, proactive response to exactly the kind of risk we just talked about. Let's be balanced and go through the real risks here. First, customer concentration. When one account can move your entire growth rate, that's a structural vulnerability, not a one-time event. Second, gross margin slipped slightly, down to 79.6% from 80.9% a year ago, small, but worth tracking. Third, this stock still trades at a high valuation, which means there's not much room left for additional bad news before the market punishes it again. None of these risks are new information exactly, but this quarter made them a lot more visible than they were before. So, is the market overreacting, or is this sell-off justified? Here's how I'd frame it. On the fundamentals side, this was genuinely a beat and raise quarter, and most of the business outside one account is accelerating, not slowing. On the sentiment side, the reaction was extreme, and the stock is now technically oversold. But the deceleration in Q3 guidance is real, it's not just a headline scare investors invented. So what does this mean for you? This isn't a case where the fundamentals collapsed. It's a case where a strong quarter came with a legitimate reason for caution, and the market chose to focus heavily on that caution. So let's bring this together. Datadog delivered a beat and raise quarter, and the market punished it anyway because of a growth slowdown tied to one very large AI customer. That's not the same thing as the business falling apart, but it's also not something to wave away either. Going forward, the two things I'd personally watch are how Q3 actually plays out relative to guidance, and whether any other large AI native customers show the same pattern. As always, this isn't financial advice, just an honest breakdown of what happened and why. If this helped you understand the story, hit like, subscribe for more breakdowns like this one, and let me know in the comments what you think. Is this an overreaction, or a real warning sign? And if you want the deeper dive with all the numbers, the full article is linked in the description.